What if I told you the world's poorest countries are secretly financing the richest ones? That sounds impossible. We grow up hearing the opposite story, that wealthy nations send aid, loans, and development money to struggling countries. That the global south survives because the global north helps it. But what if the money is actually flowing the other way? What if countries drowning in poverty are simultaneously pumping trillions into the financial systems of New York, London, and other global power centers? Because beneath the language of development and global cooperation exists a brutal financial paradox. Poor nations borrow at high interest. Rich nations borrow cheaply. Poor nations export raw materials and labor. Rich nations accumulate assets and financial power. And over time, the wealth keeps moving upward. This isn't just about corruption or bad leadership. It's structural, a global system where debt, capital flight, and financial dependency quietly transform poverty into a subsidy for wealthier nations. Tonight we are dissecting one of the most uncomfortable realities in modern economics: how developing nations became trapped financing the prosperity of the rich. The story begins with debt, not personal debt, national debt. When developing countries face economic crisis, infrastructure collapse, food shortages, or currency instability, they often turn to international lenders. The IMF, the World Bank, Western banks, foreign investors, and at first, the arrangement sounds reasonable. A country borrows money to modernize its economy, build roads, expand electricity, create jobs. Growth follows. The debt gets repaid, at least in theory. But there's a hidden problem. Most developing nations borrow in foreign currencies, especially US dollars. That means they cannot simply print the money they owe. To repay their debt, they must continuously earn dollars through exports, tourism, foreign investment, or resource extraction. And the moment global conditions change, the trap tightens instantly. If the US raises interest rates, borrowing costs explode. If commodity prices crash, export income disappears. If investors panic, currencies collapse. Suddenly, entire governments become trapped, trying to protect their financial credibility, while ordinary citizens absorb the damage. Public spending gets cut. Wages stagnate. Inflation rises. Living standards fall, because creditors must be paid first. And this is where the paradox becomes impossible to ignore. Developing nations are constantly described as recipients of global aid. Yet many send more money outward through debt payments than they receive inward through assistance. Think about how strange that is. Countries struggling with poverty are still transferring enormous wealth into global financial institutions. The poor are paying the rich. But debt is only one part of the machine. The deeper force is something called capital flight. And it may be one of the most important economic concepts most people have never heard of. Here's how it works. Imagine a country rich in oil, minerals, agriculture, or cheap labor. On paper, that country should become wealthier over time. But often, the wealth generated there doesn't stay there. It leaves. Corporate profits get transferred abroad. Political elites move money into offshore accounts. Foreign investors extract returns back into Western financial systems. The labor stays local. The money goes global. A worker in Bangladesh may help generate billions for the global fashion industry. But much of the profit ultimately settles in financial centers, thousands of miles away. Africa provides one of the clearest examples. Despite enormous natural resources, massive amounts of wealth leave the continent every year through debt servicing, illicit financial flows, multinational profit shifting, and capital extraction. This creates a devastating contradiction. Countries rich in resources remain financially fragile, not because nothing valuable exists there, but because what is created keeps flowing outward. And where does much of that money end up? Inside the financial systems of wealthy nations. Western banks, asset markets, government bonds. Which means instability in poorer nations can actually strengthen financial centers elsewhere. The global economy doesn't simply move money. It pulls it. Like gravity. But perhaps the strangest part of the system involves something most people never think about. Foreign exchange reserves. To survive in the global economy, developing nations are expected to hold large reserves of stable foreign currencies, especially US dollars. These reserves help stabilize currencies during crises. Without them, investors panic. Imports become expensive. Inflation spirals. So governments accumulate dollars as protection. But here's the paradox. What do many countries do with those reserves? They invest them into US Treasury bonds. Which effectively means poorer countries are lending money to the United States government at extremely low interest rates. Think about how absurd that is. A developing country may struggle with underfunded hospitals, weak infrastructure, and widespread poverty, while simultaneously holding billions in reserves, earning tiny returns inside the American financial system. At the same time, that same country may be borrowing money internationally at much higher interest rates. Cheap capital flows toward the rich. Expensive debt flows toward the poor. And because the US dollar dominates global trade, countries have little choice but to participate. Oil, commodities, international settlements. The modern economy runs on dollars, which gives the United States a financial advantage almost no other nation possesses. America can borrow enormous amounts cheaply because the entire world constantly needs dollar-based assets. Even poorer nations help sustain that demand. Then there's another layer most people rarely discuss: intellectual property, patents, licensing rights, technology ownership. In theory, these systems reward innovation, but globally, they often reinforce dependency. Developing nations routinely pay enormous amounts to corporations headquartered in wealthy countries for access to medicines, software, industrial technology, and scientific tools. The COVID pandemic exposed this reality clearly. Many poorer countries struggled to access vaccine technologies, while pharmaceutical control remained concentrated in wealthier nations. The issue wasn't simply healthcare. It was ownership. Knowledge had become property, and property had become power. This same pattern exists across technology, agriculture, manufacturing, and energy systems. The Global South frequently provides labor and raw materials. The Global North frequently owns the patents, platforms, and financial systems surrounding them. One side produces, the other accumulates. And over time, debt dependency begins changing political behavior itself. Governments dependent on foreign financing lose flexibility. Policies become shaped around investor confidence rather than public stability. Central banks focus on defending currencies instead of improving wages. Public spending gets cut to satisfy lenders. Privatization accelerates under external pressure. This pattern has repeated for decades. Latin America during the debt crises of the 1980s. Asia during the financial crisis of 1997. Lebanon, Sri Lanka, and Pakistan more recently. Different countries, same structure. Debt creates vulnerability. Vulnerability creates dependence. Dependence transfers leverage outward. And once countries enter the cycle deeply enough, escaping becomes extremely difficult. Because development itself now depends on participation in the very system causing the imbalance. To attract foreign capital, countries often compete by offering cheap labor, weak regulations, tax incentives, and resource access. Growth becomes tied to dependency. The ladder upward is connected to the chains below it. Now, to be fair, the global economy has created enormous prosperity. International trade lifted hundreds of millions out of extreme poverty. Industrialization transformed parts of Asia. Technology spread faster than at any point in human history. The system has produced real growth, but growth has not been distributed equally. And stability at the center often depends on extraction at the edges. That is the uncomfortable truth. The modern financial system presents itself as neutral, but power shapes every layer underneath it. Who controls reserve currencies? Who controls lending institutions? Who controls patents? Who controls global banking infrastructure? These are not small details. They determine where wealth accumulates and where it escapes. And once you see the pattern historically, it becomes difficult to ignore. Colonial empires once extracted resources physically. Modern financial systems often extract them digitally. Different tools. Same direction. Now the system itself is beginning to face pressure. Countries are increasingly searching for alternatives to dollar dependence. BRICS nations discuss new payment systems. Central banks are buying gold at record levels. Trade agreements are shifting toward local currencies. Not because the current order collapses tomorrow, but because many countries no longer trust permanent dependency. History shows financial systems never remain dominant forever. The British pound once controlled global trade. Before that came Dutch financial supremacy. Before that, Spanish silver financed empires. Every monetary order eventually reaches strain. And underneath today's global economy lies the same uncomfortable reality that has shaped financial history for centuries. Some nations consume global wealth. Others continuously supply it. And the line separating the two is often maintained not by productivity alone, but by financial architecture. That is the debt paradox. The world's poorest countries are often not being rescued by the global economy. They are helping stabilize it. And until that changes, poverty may remain not a failure of the system, but one of the features keeping it alive. Whether the system reforms or persists, the lesson from every monetary crisis is clear. Position matters more than hope. Nations that accumulated reserves, diversified trade relationships, and built domestic productive capacity survived better. Those holding dollar assets or diversified wealth abroad survived financial shocks far better than those without. The individual lesson mirrors the national one. Concentration inside a single system, a single currency, a single institution, is the highest form of financial risk. Every system eventually strains. Every architecture eventually shifts. The question is whether you have positioned yourself before or after the shift. History doesn't offer comfortable certainties. It offers patterns. And the pattern here is unmistakable. If this reshaped how you understand money and power, subscribe to Money Records. The answers have always been in the past.